From New York City, for our viewers worldwide, a very good morning. I'm Manus Cranny. So we're pausing for thought. We've got Kashkari later on in terms of the Fed speak, but it's not exactly a whole new world at Disney. The stock is lower. Bob Iger has a challenge to do. Subscribe more. Countdown to the Open kicks in right now. Coming up in the show, those futures, they lack conviction after a strong start to the week. Traders brace for more Fed speak with limited data on the docket. And shares, as I said, in Disney under pressure. The subscriptions miss the mark. We begin with the big issue, growing rate optimism.
As the data come in, hopefully we'll be moving in the direction we want to see, both on inflation and in terms of restoring balance to the economy, and then we'll make our decisions based on that.
If they haven't cut in September, they're likely to cut in December. Again, there's still a question of, will inflation actually decelerate enough by then?
It is going to come down to that disinflation narrative. Mike McKee is with me. Mike, what did we learn yesterday and what are we set for today? We've got big auctions, but a mountain of Fed speak to get through before the end of the week.
Well, the auctions might end up being more important because they're today. There is a question about how much there's going to be take-up of the Treasury debt and at what price. But we do have a lot of Fed speak that probably isn't going to add much to the discussion because, as you heard, people have already made up their minds on the Open Market Committee that they're going to wait for a while. Here's what Tom Barkin from the Richmond Fed said yesterday. He's optimistic today's restrictive level of rates can take the edge off demand in order to bring inflation back to our target. The full impact of higher rates is yet to come. Now, that kind of explains where the Fed is at and why the markets don't necessarily like it. Take a look at this chart here. The Fed is looking at real rates. And as you can see, real rates are at levels that led to recessions in the past. The market is looking at the blue line below, which is financial conditions, which have loosened. And they think the Fed might be setting us up for additional inflation. So who's right? Well, there's going to be a lot of data between now and the June 12th Fed meeting, and that inflation data is going to be very key. So while we may not get something new out of the Fed speakers this week, we do have CPI next week. The Fed minutes, did anybody at their last meeting talk about raising rates? And then another PCI, another CPI before the Fed meeting. So they'll have plenty of data to look at and see if they have that confidence they're looking for to lower rates.
Well, that conversation on raising rates was something that Powell really did push back against. Mike, thank you very much. Mike McKee. Today, we have an interview. We will bring that to you with the Minneapolis Fed President, Neil Kashkari. That's coming from the Milken Conference at 1 p.m. on Bloomberg TV and radio. Let's continue the conversation. Quincy Krosby of LPL Financial and Ed Al-Hussainy join me from Columbia Threadneedle. Gentlemen, good to see you both. 5 days that shifted the dial on 10-year, 2-year and 5-year paper. This is the 10-year government bond yield down by 23 basis points in the space of 5 days. The bond market's faith in rate cuts has been restored. Has yours? Ed, good morning.
Hey, good morning. No, I think you're absolutely right. I think it was really a function of the Fed reminding us that the threshold for rate hikes remains relatively high. And that's something that was kind of seeping back into the market given the inflation data in Q1. And the Fed's effectively taken that off the table. That's been a really nice temporary ceiling, I think, on the longer part of the curve.
Okay, so that's a nice portion. Quincy, good morning to you. Here we are. You know, the equity market has taken flight. A number of reasons. You have earnings, but you have this repricing at the very short end of the curve and the faith in cuts, perhaps not fully restored, but reignited. What does it mean for you?
Well, one of the other aspects for the market is the liquidity that the Fed offered with the quantitative tightening program. That certainly helps the market, and it helps the market for a number of months, probably going through to the election. But overall, the earnings have come in better than expected. Obviously, the market is now waiting for the 22nd when we hear from NVIDIA. But overall, this is a market that needs something. If we're not going to have rate cuts, you've got to substitute something else. And that has to be a economic backdrop that is not hot, that's not cold, but just looking at a rebalancing of this economy and a cooling of the data. But overall, we have seen the market with the S&P 500 regaining its 50-day moving average. But one thing we have not seen is on the days that the market has been up, closing higher, the volume hasn't been there. It tells you that the market needs more confirmation for an endurable rally. If this rally can continue, it is going to probably lead us with a strong market through the summer because the historical patterns indicate that. So I think absolutely that where we land with the 10-year Treasury, where we land with the 30-year, with these auctions, it is going to be, we hope, a catalyst for this market to say, okay, this is what the auctions are telling us. Let us move ahead and offer more confirmation to the equity side of the market.
So, Ed, it's up to you and your tribe to deliver. 6-month T-bills were welcomed over 3 months as that rate cut narrative got wound up. We've got 42 billion in 10s. We've got 25 billion in 30s coming a little bit later. Now, as Quincy says, it's over to you. Prove to us that you can eat a bountiful meal and not get any indigestion. Is that how you see the 125 billion that we will have had by the close of business this week?
Yeah, look, I think demand for duration assets, long duration assets, whether they're coming from the Treasury side of the house or high quality investment grade debt, has been really well met this year. I don't really see significant issues in us being able to digest this supply. On the margin, the Fed's balance sheet is in the background. It provides a little bit of background music. I don't think it's all that important for taking down these auctions. I think the key issue here is the all-in yield, whether you're looking at the long end of the Treasury curve or, again, you're looking at it through a credit lens, the all-in yield is very attractive. And there's plenty of institutional investors who are still coming off the sidelines into this market. So I'm not really concerned at this stage that we'll see any kind of dislocations in these auctions.
So, Quincy, back to your point, which is, you need to see some kind of, as it were, confirmation of this Goldilocks-like scenario. I was looking at what Morgan Stanley have had to say, and Ed, you can chew on this, which is buy bonds because there will be a rapid deceleration in PCE without the economy tanking. So to your point, Quincy, this is really what we need to see. We need to see reasonable growth with reasonable profit margins and a dissipation in inflation. Is that enough to put a floor in equities and maybe even propel it higher?
Well, yeah, I mean, one of the things we're seeing from this earnings season is that profit margins have been strong. We always look for that because that is the key to whether or not they are going to have to turn around. These companies are going to have to turn around and let people go. The labor market, yes, it is holding up. It's solid. But there are questions as to how long this can continue, because after all, that is the pathway towards a recession if the consumer feels that there are no jobs and they start seeing major layoffs. So we go back to the earnings and we hear operating margins, okay, profit margins, okay. That is excellent for the tone of the equity market. What we want to see, though, is that the yields are not coming down so quickly because they are looking at a much weaker economy. When we look at utilities, utilities have very often been that guide that when rates are higher and utilities do well, it is the utilities market suggesting, we're reaching a top. We're going to start seeing the rates come down. But there's another element now for utilities. Is it also suggesting that, we're going to need to upgrade our grids? We're going to need more power for the data centers. So that's also entering into the conversation about what utilities typically tell us. But overall, what this market doesn't want is a escalator down or an elevator down quickly with those yields.
So, Ed, with that in mind, just listening to what Quincy's saying is we don't want an escalator down in terms of what's going to cause yields to drop. And this goes back to what Morgan Stanley are saying. They said it is residual seasonality that will impact the slow drift lower in PC, not the escalator down that Quincy is outlining that we don't want. Which one do you expect is the firmer narrative?
Yeah, look, I think there's a really good probability that inflation, the decline in inflation was a little bit exaggerated into the end of last year. It was perhaps a little bit exaggerated to the upside in Q1. And, underlying inflation is running at about 3%. We're likely to see some cooling off of those levels. The thing that I'll point out is if you look at where rates and risk markets are today, they've priced in very healthy growth, close to 2.5% consensus. They've priced in relatively lax financial conditions. And they've priced in a little bit of room for the Fed to cut, roughly 40 basis points. Let's call it 2 cuts this year. That's consistent with some of that inflation coming down. So that Goldilocks scenario is very much already in the price. And I think what worries me is with expectations being nailed to the ceiling, particularly around growth this year, it's going to get a lot easier to disappoint them to the downside. And I think we're starting to see early signs of that in the labor market. We're starting to see early signs of that in the growth story.
Well, we are. We certainly saw some cracks in the services industry. We've seen trading down, perhaps, at some of the broader retailers. Quincy, let me get your perspective. Disney has been sort of a couple of different stories this morning, but if I look at Disney, it is about subscriber growth disappointing relative to what the market wanted. The CEO's on the tape now talking about password sharing, cracking down on that. The stock is down by 8%, but when I look at the business, parks growth is moderating from peak COVID levels. It's more about a normalization on the consumer side of the business in of itself. What did it say to you? What does Disney say to you about the health of the consumer?
Well, yeah, no, I was watching that very closely, but you still see the growth in terms of the parks. It was over in Asia. It was in Asia, over in California. It was much slower. When we look at Florida, we know that the numbers are coming down. It's too expensive for the average American to even go with just one child. And this is a tell, not just from Disney, but it's a tell across the consumer-led economy. That at what point do consumers, not just the low end of the wage scale, but mid-wage earners, start to pull back and say, I've really got to pull back. So far, that isn't the case. Americans are spending. They are going on vacation. They're booking tickets on planes. The Amex, which looks at business spending very much, says things look good. From the other credit cards, they say, you know what? Americans continue to spend. The Fed, if you listen to Powell, he talks about that low wage earner and concern about that particular cohort. And that suggests that this Fed still wants to be able to cut rates, perhaps even with stronger inflation. When we looked at the ISM, Institute for Supply Management, the service sector, it pulled back into contraction territory. Mm-hmm. But just like with the manufacturing, the prices paid up. That is inflationary, and you can't dismiss it. We need to see those numbers come down for the Fed to feel secure in saying, okay, maybe now we can cut rates. Maybe September, maybe too soon. It'll look as if we're political. Maybe December. But you can't have them cut rates when those prices are climbing higher in the backdrop of weaker growth. I hate to tell you, everyone knows what that means if it continues. It is not a healthy backdrop for this economy or for the markets.
No, but then it almost feels as if it's the slow cut of 1,000 cuts, isn't it? A little bit of ISM slowing down, a little bit of consumer slowing down at Starbucks, a little bit of consumer slowing down at other retailers. Ed, to what extent are you and the bond team buying into the hypothesis or believe in the hypothesis that immigration, as Adam Posen said to me, if you're not a border politician, immigration is good. It contains the wages spiral. Is that part of the alpha for bonds going forward?
I mean, immigration's been a really interesting story. It's definitely played a big role in adding to the supply side of the labor market. The extent to which it's impacted wages is probably relatively small in my mind. Okay. last year we were talking about 3.5 million people missing as a result of lower participation post-COVID and missing migrants. Now perhaps we're about 2 million people above trend. So there's been a swing of about 5 million workers. Our labor force is 160 million people. So the extent to which that 5 million makes an impact on wages is not huge, but it's important. It's good towards balancing out the number of vacancies and so on that we have in the labor market, and it reduces the churn in the labor market, which is something the Fed's been looking for. Does it impact wages? I would say not really.
Okay. Well, maybe it is that we need to redefine what scale of immigration, what type of immigration contains wages in various component parts of the economy, rather than that sort of umbrella statement about immigration. Ed, thank you very much. Quincy Krosby and Ed Al-Hussainy on the markets this morning. Let's look under the hood. Ahead of the opening bell, Abigail Doolittle is with me. Abby, what have we got?
Well, despite the fact that we do have the U.S. equity futures slightly higher, we have a couple of notable laggards to take a look at, including Disney. Shares heading to the worst day in about a year, down 7.5% for the reasons that you all were just talking about. Streaming subscribers coming in short of the estimate, a lagging growth in parks ahead. They did raise the revenue guide, but it was slightly short of the street. And into today, up 29% over the last year, so investors wanted more. Palantir down 12.4%. The data company boosted its forecast, but not enough for a stock, if you can believe it, up 226% over the last year into today. Price to perfection, you could say. But take a look at Peloton, up 20%. CNBC reporting that a number of private equity firms are circling, considering buying the fitness company Manus.
Okay, Abby, thank you very much. Keeping an eye on those stocks as they move. Coming up, Disney beats profit estimates.
We're obviously very judicious with the way that we price. We want to provide access to as many guests as we possibly can. But we do believe that the great experiences we provide, people are willing to pay for.
Strong earnings report overshadowed by that miss at Disney Plus on the subscriber side. All in conversation next on Bloomberg.
We took prices up a little bit in the beginning of this year and didn't really see much of an impact. So as to what the future brings, we're obviously very judicious with the way that we price. We want to provide access to as many guests as we possibly can. But we do believe that the great experiences we provide, people are willing to pay for.
Well, Disney stock is slumping pre-market despite beating on profit estimates and raising the guidance. What spooked the investors is this: fewer subscribers to the Disney Plus streaming service than was expected. Geetha Raghunathan is with me now from Bloomberg Intelligence. I mean, this stock has been everywhere this morning. We're down over 8%. They're talking about cracking down now on the password sharing, so very reflective of what Netflix did, Geetha. Why such a virulent reaction to the miss on subscribers?
Yes, so I think it might be partly subscribers, Manus, but I think the bigger reaction is really caused from the commentary on the parks business. Remember, parks is the main anchor of the whole Disney company. It brings in about 2/3, almost 60 to 65% of total company profits. And basically what they guided to was not only a little bit of a weaker outlook for the next quarter, which is fiscal third quarter, but also they spoke about a moderation in demand. And when you see a moderation in demand, then that really kind of worries investors, because then there are questions about pricing power and whether the business can really kind of sustain momentum going forward.
Yeah, and therein lies the point, isn't it? It's about how expensive. Our last guest was talking about the expense, the cost of actually going to a park in America relative to perhaps some of the others. The stock is down 8% pre-market. Geetha, thank you very much. Another stock that we're keeping an eye on this morning is Boeing. Now, the plane maker is facing yet another investigation from the U.S. Federal Aviation Administration. This time it involves the flagship 787 Dreamliner model. Sid Phillip is with me now. So, Sid, this is to do with, again, attention to detail in the checking process on the plane between the wing and the body. Talk me through what is exactly challenging them again today.
Morning, Manus. So yes, Boeing is in the throes of yet another investigation, this time over their 787 wide-body model, which is their advanced model and their flagship, essentially. And what a whistleblower at Boeing alleged was that shortcuts were taken and crucial tests that were meant to check the attachment of the wing to the body of the aircraft, they weren't conducted, and essentially they alleged that they were essentially overlooked, and they fraudulently signed off documentation, said those tests were completed. And that's really added another sort of layer of complexity to Boeing's already growing sort of regulatory scrutiny, and that's just going to add more pressure to the company at the moment.
We also caught up with Sheikh Ahmed bin Zayed Al Maktoum. He is the chairman of Emirates. He said, the delay that we see, I don't think that we're happy. So again, you've got Michael O'Leary being supportive to Boeing. You've got Sheikh Ahmed, again, trying to be supportive to Boeing. Is there some kind of an inflection point here? The fact that Boeing came forward with this information, should the market, is that what the market is taking some substance from?
At the moment, there's a lot of unknowns really in terms of what the impact of this is. I mean, they haven't really said how many aircraft are affected. Boeing's talked about how the FAA said there's no immediate danger to the in-service fleet in terms of requirements for grounding or any of that. But at the same time, it's going to be crucial to see how many aircraft are impacted. And the FAA has asked Boeing to come up with a plan for the inspection of the in-service fleet. It can also impact deliveries of the 787, which is a crucial source of cash for Boeing. So that's really the key in terms of what the impact is going to be, and that's really going to have an impact on share prices as we go forward.
Okay, well, certainly the message from Emirates is that the management promised that they will change things and make things go faster. To coin a phrase, I hope so, from Sheikh Ahmed. Sid, thank you very much. Sid Phillip tracking the Boeing story. Coming up, your morning calls. A little bit later, we've got B of A's Wamsi Mohan joining me with his outlook for Apple. And that's after he named it as his top pick in the earnings season. Early, prescient, and on the money on Bloomberg. Let's get you some of your morning calls from the analysts on Wall Street. First up, TD Cowen downgrades CVS to a hold, citing further downside risk and uncertainty after Q1 results. Bank of America adds Nike to its US One watch list, naming it as their best investment idea for the year ahead. And finally, Citigroup upgrades Target to a buy, pointing to strengthening margins and improving inventories. Coming up on the show, he is the analyst that called Apple his top pick. That was ahead of the earnings. Bank of America's Wamsi Mohan joins me. We preview the Giants' big event on Bloomberg. Tentative bid in these stocks. We're really trying to sort of find our footing. I don't know whether we can bloom for as long and last as long as flowers.com, but right now this market is up. We're going to get a little bit more Fed speak later on in the day. Yields are lower, and that is what's driving the breadth story today, up by 0.2% on the Russell 2000. This is how the rest of the market looks. You've got the euro dollar trading a little bit higher. The German factory orders actually were a little bit lighter on their feet. Demand falls in February, so that's from February, I should say. So those numbers a little bit lighter in Europe. 10-year yields down 4 basis points today. I can tell you in the past 5 days, there has been a continual momentum down in yield on the bond market, down by over 20 basis points at one juncture. Crude is down by 0.25%. So that's the state of play across the assets. One stock to watch, we've touched on it a few times, it is Disney. The shares are under pressure, posting fewer than estimated subscribers on the Disney Plus streaming service. We've already had a conversation, Abby, haven't we, where it seems to be about the parks business also under pressure.
Yeah, that's exactly it, because that parks business really the reliable cash cow, and now there's some concern that growth for the current quarter, because it's basically flat, investors concerned, worried that maybe there's going to be some sort of an issue there. Relative to the stock, you can see that it's really plunging down 8.5%. Its worst day since last year. At the lows, though, this morning, just moments ago, down 9.3%, the worst day since November of 2022. So investors really concerned again, despite the fact that they did beat profits, there was a small revenue miss. When you put it all together, they raised the fiscal year profit view from 20% growth to 25% growth. The street looking for 25.5% 0.5%. So a small miss there. To your point again on Parks, the growth is expected to moderate. The small subscriber miss for a stock that was up 29% this year into this report. Over the last 3 days into the earnings report, Manus up 5%, really suggesting that investors were looking for just a clean quarter and guide across the board. They didn't receive that. This stock now, again, down 8% on the morning.
Yeah, pretty brutal. Abby, thank you very much. Let's turn our attention to the software market. Palantir falling after investors were unimpressed, to say the least, by the company's outlook for its annual sales. The stock has tripled this year into the numbers. That's some context for us, Alex, isn't it?
It is, Manus. Well, unimpressed is definitely an understatement when it comes to this report. The company actually did deliver on earnings, but it didn't deliver on guidance. That likely explains the downswing that we're seeing this morning. Shares down about 11%. That's the worst since November 2022. And the company, co-founded by Peter Thiel, is one of the emblems of the AI frenzy that's helped shares surge more than 200% in the past 12 months and about 15% in the 4 trading sessions leading up to the results. But investors were unimpressed by the outlook for annual sales. It nudged up its annual revenue forecast slightly higher to a range of $2.68 billion to $2.69 billion. That is roughly in line with Wall Street forecasts. This reaction, Manus, is a testament to how high the stakes are for companies to deliver on their AI promises. And it's not just about what companies have shown so far, but what they see for the future. And it's really been a theme this quarter. More than 80% of companies have beat earnings this quarter, but we're getting the worst same-day earnings reaction since the end of 2020, and that is attributed to these disappointing outlooks. William Blair says that Palantir is down because of the sharp deceleration in U.S. commercial revenue growth. That's a focus for investors because of the AI push, Manus.
Okay, well, certainly a double-digit loss on the ticker at the moment. Alex, thank you very much. Turn over to EVs now. Lucid revealing wider than expected losses to the start of the year. This is as the company contends with production challenges and an uneven roadmap for demand. Katie, just put the two together. This is a bit of a slap down by over 9% at the open.
Yeah, and you really are seeing that pain reflected in the shares, like you said. Let's get into some of the numbers here, because Lucid, it posted an adjusted loss of about 30 cents per share in the first quarter. Analysts had been expecting a loss of 25 cents a share, so clearly a bigger loss than expected. Revenue of about 173 million, that was above expectations. Clearly, that is not the focus this morning. And like you said, Lucid really trying to overcome production hurdles and at the same time sagging consumer demand for EVs. It recently secured about a $1 billion cash injection from a Saudi investor. So maybe that will continue to or start to bear fruit, because Lucid said that it still expects to make about 9,000 vehicles this year. That is reaffirming their earlier forecast. But you take a look at what Bloomberg Intelligence has to say, and their view is that Lucid's Air sedan could, quote, keep dragging on profits, while production increases planned for this year could hurt margins in the second half. You add it all together, shares down about 8% almost at the moment, lower by about 33% in 2024. Just to give you some context, Manus, that is even more than Tesla's year-to-date loss.
Okay, Katie, thank you very much. Katie Greifeld there. Turning to tech. Apple has been developing a homegrown chip to run AI tools in the data centers. That's according to the Wall Street Journal. Alex Webb is with me now. I mean, they're all trying to come up with a solution where they may not be so inextricably linked to NVIDIA. I'm talking about a lot of these players in the Mag 7. But talk me through what Apple are doing and whether it will come to fruition according to the story.
Yeah, so the Wall Street Journal is reporting that they are working on this product. We don't yet quite know what stage of development it is, whether it actually will ultimately be produced, but it is something, these chips geared towards AI, presumably accelerators. Every big tech company is working on them right now, and Microsoft, Google, Meta, and Amazon even. Now, part of that, one suspects, is that yes, it will help them build chipsets that are finely tuned to their needs, their precise needs, what they want to do. But also, NVIDIA right now, which is really the only game in town, has a huge amount of pricing power. What we've seen over the past 12 months with the huge acceleration in NVIDIA shares is not just that they're selling more chips, but they are selling the chips they can for more money. And so if you are an Apple, you're probably going to be looking for a little bit of pricing power.
Okay, Alex, thank you very much, tracking the Apple chip story. Our next guest, pretty much ahead of the pack, making Apple his top pick. That was late April, and he wrote this, that the company has a rich catalyst path with defensive cash flows, to say the least. Wamsi Mohan joins me now, Senior IT Hardware Analyst over at BofA Securities. Your price target is $230. What goes through my mind as they announce the biggest buyback in the history of American equity? Are they on defense or offense on the payouts and buybacks? Wamsi, good morning.
Good morning. Thanks for having me. Yeah, I think this is sort of par for the course is the way I would phrase it, right? Like if you think about what Apple has been doing, they've been very consistent and opportunistic in their buybacks. Over time, their buyback program has been extremely successful. And it helps, of course, as the stock is up to the right. But when you look at sort of the magnitude of what we're talking about, the 110 billion, right, and Wall Street was largely expecting, we were expecting 90 billion, it just shows the confidence in the cash flows. And this is what we meant by saying there is a defensive moat around the story in terms of continued earnings power and continued cash generation, such that they can keep this level and pace of buybacks, which are, just astounding, ongoing. And that confidence in cash flows is really coming because they do have this potential to really tap into a lot of markets that are not on people's horizons today, right? When you think about healthcare market, for instance, or you think about the advertising market, there are just these huge TAM opportunities that are ahead of Apple still, and everyone's very fixated on the quarterly numbers of the iPhone. I think it's time to step back and really take assessment of what are the long-term opportunities for growth, and those are some really huge potential TAMs.
Okay.
And we just, your prior guest was talking about the AI server chip market. That's another potential large market, right? So there are a lot of untapped markets for cash flows.
Well, what goes through my mind is, of course, are they the good guardians of capital? In other words, returning it in the form of share buyback relative to perhaps the perception is in other Mag 7 stocks that you're squandering it on moonshot ideas. So this is about governance and I would say prudence over capital. When it comes to innovation, Apple, they create products that we never knew that we ever wanted or needed. We've gone into the Gobi Desert, as it were, of innovation. We're in the desert at the moment. So where do you think their biggest bets will be on the innovation that we don't quite know that we needed yet? You've mentioned health and you've mentioned chips. As you look towards these big reveals later in the year, where do you think the biggest reveal could come?
Yeah, I would sort of look at innovation a little bit differently, right? And yes, an iPhone 15 versus iPhone 14, incremental for sure, right? But at the same time, when you look at an iPhone 11 versus iPhone 15, that's the order of magnitude improvement in camera quality, in microphone and speakers, and audio and spatial audio. So innovation is well and alive. It's not completely obvious on the surface of it. We think that a lot of the innovation actually is beneath the surface, right? And when you think about that, that's really, it comes down to their silicon innovation. And they've been designing more and more and more chips that are tailored to their needs, whether it be for spatial video, whether it's all the new chips they put in the Vision Pro, right? So there's this silicon innovation, and that takes time. It takes consistency. It takes 4 or 5 year cycles. So what we're talking about at Apple really is a vision into the future where they're currently working on projects that are 5 or 10 years out. That is the level of cadence you need for a company that's churning out, 250 million iPhones a year, right? So when you think about the next step really around innovation, what we think is that generative AI is going to be a huge catalyst. And why is that? It's because, not only do they have leading edge technology in silicon, they're going to embed more and more of that compute density locally. They have the best data on the planet about anyone sitting on device. So it fits Tim Cook's perspective on privacy, where nothing has to leave the device, but at the same time, you're able to really monetize that at 2 levels. One, from giving you a very good hardware experience on device, and secondarily, by enabling developers to really tap into this hardware and then monetizing it at the services layer. So we think this is a multi-step opportunity for in generative AI that's going to be a huge next catalyst for Apple.
Okay, well, we have the big reveal on the iPad. I don't think that's going to be the transformative moment in sales and volume, but it will be a mini curtain raiser. can I just square off China? Many people come in here and they go, Wedbush Securities being one of them, Dan Ives going, he's an evangelist, he's a Sinophile, the worst is past, and there will be better times ahead. You would also concur and say that the China woes are unfounded. But I would put it to you, we've got the same set of risks in China. The risk parameters in China have not changed. So what gives you the confidence to say that China, the concerns are unfounded?
So I think that we have to put the China concerns in context, right? When you look at China, it is still a ginormous market from a demand opportunity standpoint. You still have a lot of the middle class that is coming up in tier 2, 3, 4 cities where the amount of spending power is increasing. And if you think about Apple actually grew units in mainland China. Not in Greater China, but they did in mainland China. And that is despite facing some tougher compares from a year ago and 3 points of currency headwind. So when you dissect all the numbers, the iPhone franchise in China is alive and kicking. Has Huawei taken some share recently? Yes. I mean, Apple has had free reign of the China market for 4 years when the U.S. put restrictions, and clearly Apple capitalized on that. Is there going to be some period of give back? Yes, there can be some period of give back. Does it mean that this is structural? No, we don't think that means it's structural. Apple will continue to innovate. We're not seeing a mix down even in China. Yes, there is some promotional activity, and every company does that at cyclical times of need, and so did they. And so when we put this into context, we think that longer term, this is a big opportunity, continues to be a big opportunity for Apple. We think that, again, like when you have a device that is capable of doing things truly to improve productivity, like the iPhone can when generative AI features are embedded in it, we do think that the China market and China consumers will embrace that. Form factor change has not been something that has happened recently. China consumers love that. We think Apple's going to do a foldable over the next several years, and that's going to drive increased interest in an upgrade cycle too. So it's just that I think people tend to look at it from a very static standpoint, whereas Apple is innovating behind the scenes and coming up with interesting technologies that will capture the fascination, we think, of Chinese consumers apart from the global consumer base.
Okay, well, you made the call, Wamsi, and the stock certainly has responded after that buyback and the shift in the narrative. Wamsi Mohan over at Bank of America Securities. Breaking news on international paper now. A deal may be in the offing. Abby, what are the details?
Indeed, Manus, we do have breaking news. Reuters reporting that Suzana, the Brazilian biodegradable company, they consider themselves a bioeconomy company, has made a $15 billion takeover offer that equates to $42 per share. So international paper moving up toward those levels. At the high, international paper had been at 41.30 at that point, heading to its best day since March of 2020. Making this news perhaps more serious or more credible is the fact that the shares of Suzano right now down nearly 6%, heading to their worst day since December 13th, 2022, Manus.
Okay, Abby, thank you very much. Breaking news headline there. We bring that to you. Coming up, UBS returns to profit.
Actually, it's a good momentum. May remember in the fourth quarter, we also had a very strong performance in banking. As we integrate the new colleagues from Credit Suisse on our platform, we start to see the pipeline developing. We are able to execute.
We discuss the bank's latest earnings release right here on Bloomberg, where context matters.
Very good progress on our integration plans, but also it was great to see a very strong return on to profitability, both on a reported basis, but also very strong underlying profits. We also see good momentum with clients, with inflows across our businesses, and our capital is strong, so allowing us to continue to pursue our capital return plans. Actually, it's a good momentum. You may remember in the fourth quarter, we also had a very strong performance in banking. As we integrate the new colleagues from Credit Suisse on our platform, we start to see the pipeline developing. We are able to execute. And so it's very much aligned with our expectations of improving the mix between our markets business and our banking business in the investment bank.
UBS returns to profit after its rescue of Credit Suisse. The move reversing 2 loss-making quarters thanks to the strong performance in managing wealth and investment banking. Tom Metcalf is with me. So the lean into FX didn't injure, the lean into FX over rates didn't injure them. But the real growth, Amotti says, came here in the US and in Asia. Tom, good morning.
Hey, good morning. Yes, very strong quarter for UBS. You can see that in the shares. I think they're up about 9% at the moment. As you say, lots of growth areas, pretty much a clean bill of health. And, you know, profit really trumping those estimates from analysts. I think one thing to keep in mind is some of this is accounting driven relating to this integration of Credit Suisse. So their legacy unit did very well this quarter. That's not necessarily sort of sustainable quarter in, quarter out. But by and large, you know, shareholders will be very happy with this and the sense that UBS is sort of moving ahead, integrating Credit Suisse and finding ways to bring in more clients.
They are indeed, and they're already, I mean, the big debate is the amount of extra capital that the regulators, pressured by the government, they're going to make. And he's saying we've already started adding about $20 billion in capital, and it's too soon to jump to conclusions. But of course, everybody salivates, especially on bond desks, about the size of their bonus. We're now at the end, we're midway through second quarter, and it's going to be the traditional, as it were, people at the table: bonds, equities, fixed income, investment bankers. Who's going to get the best bonus, Tom? How's it shaping up?
Yeah, some really interesting data from a report looking very early at 2024 bonuses. And, you know, if I could switch jobs, it looks like I should become a debt underwriter, because they are up something like, or thinking they get bonuses up about a quarter at the high end of things. So very strong performance there. As you say, the bond traders, there or thereabouts, 15% or so. One of the things that caught my eye was actually the investment bankers. You know, we're seeing deals come back, but because they're on a bit of a lag, because those deals take a while to actually complete, even though we're getting all these positive headlines, this report, at least from Johnson Associates, is saying their bonuses will be so-so this year.
OK, Tom, thank you very much. Tom Metcalf there on the very latest thinking for UBS and your bonus. Coming up, sector price action for the morning. Let's get across to Abby.
So a few interesting things going on, Manus. First of all, we have the S&P 500 up slightly, up 0.1%, but that means the S&P 500 is up for a 4th day in a row, the longest winning streak since March 21st, and that's right before we started to see the weakness. So the bulls, the near-term dip buyers, trying to take out the sellers. It hasn't happened yet, but you can also see it's on breadth. Consumer staples up 1%, real estate up 0.9%. A lot of sectors higher today. To the downside, tech and discretionary, but down ever so slightly, down to a greater degree, and I'm not entirely sure what's behind this. The NASDAQ Golden Dragon Index today is down more than, it had been down more than 2%, right now down about 1.9%. This may be after a period of strength, a little bit of selling there for some of those China tech ADRs, Manus.
OK, Abby, thank you very much. Coming up on the show, market moving events to set your clock by. The Trading Diary on Bloomberg. Force is strong, the Fed is with you. That's the narrative in the market. This is 5 days that changed the bond market's thinking. We're down by 23 basis points. It's the same right the way across the curve. Part of that bond market repricing is transferred into a quasi-floor on the equity market. You get some pretty big moves in the equity market this morning. We're putting in a firmer footing across the board, flat on the NASDAQ. The Russell, again, playing into this narrative that you will potentially get rate cuts. One stock to keep an eye on is Disney. It's not so much the subscriber base. That's where the market first hung its hat on this morning. It's about the reality of what it costs you to go to Disney in the United States of America relative to Asia and relative to France. The stock is down there, as you can see, by over 8%. Let's get you set up for your day ahead. This is what you need to know for your trading diary. We've got the Minneapolis Fed President Neil Kashkari joining the team, 11:30 a.m. Eastern Time. And then it is all about the bond auctions. As I say, $58 billion of threes. That's at 1 p.m. They turned up in size for the 6-month and 3-month bills yesterday. Uber earnings on Wednesday. Fed speak, more of it on the same day. Jefferson, Collins and Cook on Thursday. And finally, the Bank of England, the rate decision, that hits the tape. That was countdown to the open from New York right here on Bloomberg. All the volatility and all the flow Good morning.